Okay, welcome back to the homework channel. Today we're going to talk about the homework for Chapter 9, also for inventory. We have three problems for this homework assignment. The first one, LC NRV. Okay, so let's take a look at this question. Okay, we're going to find out LC NRV for this company's inventory. Then we're going to make the adjusting entry. Alright, so the company has inventory balance and also the allowance to reduce inventory to NRV credit balance, which is normal. The company has 4 inventories. Okay, and we have the information cost, replacement cost, sales price, NRV, normal profit. And we know we're not going to use all of them because for LC NRV we care about cost and net realizable value, whichever is lower. And also the company applies the rule to each item in inventory. So we're going to determine LC NRV for each inventory items, and then you can add it up to get the company's total LC NRV. Alright, so let's take a look at the first inventory, aluminum siding. The information we're going to look at is its cost. Okay, we're going to look at its cost, 34,000, and then its net realizable value, 24,000. Obviously the net realizable value is lower, therefore the LC NRV for the siding will be $24,000. Alright, then we're going to look at the next one, the cost and net realizable value. And in this case, again, the net realizable value is lower. So LC NRV equals net realizable value. For the glass doors, the cost is lower. So the LC NRV equals the cost. And finally for the window, we'll report $38,000. So if you add the 4 inventories LC NRV together, we're going to get the company's total inventory at its NRV. Alright. So, but the current inventory cost is reported at this number. It's current inventory cost. And what we want inventory to be reported at 250, 800. So the difference between these two will be the adjustment to the allowance. Not adjustment to the allowance, will be the allowance. Okay, will be the allowance. $17,200. This is the allowance we need to reduce inventory to NRV. Okay. In other words, this is a desirable allowance. Desirable allowance. And how to achieve this allowance? Remember, currently we have 11,700 allowance, but that's not enough. We need 17,200. So we need adjusting entries to make a big allowance. The difference will be, right, It's negative, which means we have a loss. Okay, we have a loss. We're going to book a loss, debit loss. Then we're going to credit the allowance to reduce. So you're going to write to the rest to reduce inventory to LCNRV basically. Or you can just write LCNRV reserve. All right, this is for the first question. And for the second one, we're going to talk about gross profit. Okay, I'm not gonna work the whole process, but I'm gonna work this question partially. So for the gross profit, basically we're gonna find out the cost of any inventory, based on the relationship between the cost and sales. Okay. So let's take a look. We have inventory, beginning inventory. We have purchase. We have freighting, transportation cost. We have purchase allowance. We have sales number, and the sales are made at 25% above the cost. Okay, above the cost. So the gross profit is measured at 25% above cost, okay, which is important. So in other words, if we have a cost, inventory cost is $100. Right? So sales were made at 25% above the cost. Then sales must be made at 125, right? So the gross profit, which is the difference between these two, will be $25. Okay. That's relation. All right. So we're gonna apply the inventory formula, beginning inventory plus purchase Of course, we need to plus the net purchase, which means we're going to deduct the purchase return allowance. We're going to less purchase return allowance. And we're going to add any transportation cost, which will be treated equally as purchase. So beginning inventory plus purchase equals goods available for sale. If you add them together, we have goods available for sale. All right, the key here is to estimate the cost of goods sold, because goods available for sale minus cost of goods sold equals any inventory. This is what we want, right? So let's estimate the key of cost of goods sold. And how do we estimate? We're going to estimate cost of goods sold from its sales number, Now, if the total sale is $330,000, then what is the cost? Right, so we're going to apply the formula. Cost of goods sold equals sales divided by 1 plus the gross profit percentage. So and this formula is used when the sales cost of goods sold with when the gross profit is expressed as percentage of cost. Okay, we're going to use this formula. So in this case, the sales is 330,000. We're going to divide it 1 plus 25%. All right, so if you do this, If you do this, the cost of goods sold will be $264,000. Goods available for sale minus cost of goods sold equals end inventory. So if you take the difference, the end inventory should be $94,000. This is from our calculation or estimated end inventory. But our physical count is we only have $44,500 left because of the fire damage. We can easily estimate what are the value for those goods destroyed in the fire, right? By taking the difference between these two. Right, $49,500 inventory were destroyed in the fire. All right. So the next question B is, when assuming the other things are equal, but we assume that gross profit is 25% of sales. So we're going to hold a different relationship. So if the sales is $100, right? If the sales is $100, and then gross profit is 25% of sales, then which means 25. Then what is the cost? Cost equals sales minus profit, right? 75. This is a new relationship. Now the front part will be the same. Front part will be the same. We're going to copy all these right here, but the estimated cost of goods sold will be different. We're going to estimate cost of goods sold with this new relationship. Now, we're given the sales now is $330,000, but what is my cost? What is my cost? So we're going to use a new formula. Cost of goods sold equals, right, sales multiplied by 1 minus the gross profit percentage, right? So if you do this, the cost of goods sold in this question will be $247,500. I'm going to follow the same thing. We're going to calculate goods destroyed in the fire. All right, just for the second question. And for the third one, we're going to talk about retail inventory. The retail inventory, very similar to the gross profit. We're going to estimate cost of an inventory based on relationship between cost and sales, between cost of sales. All right, so we have the information for the inventory, beginning inventory purchase at both the retail or sales and the cost information. Transportation only we have cost information, and purchase return we have two cost, the cost and the sales information. We have markup and markdown, which will be used differently under different retail inventory method. Then we have the inventory loss. This is normal loss, normal breakage, okay, and sales return. All right. So basically, we're going to apply the formula. All right, beginning inventory plus purchase. We also have the transportation cost, right, freight in. And also we have the purchase return, I think, which will be reduced, right? All right, let's put this information together. So we have two columns. We have its cost and also its retail value. So beginning inventory cost, retail, purchase cost, retail, Then the transportation cost, we only have the cost information. There's no retail for the transportation cost. And then the return will be shown as negative number here. Alright, so purchase, beginning inventory plus purchase equals goods available for sale, right? Goods available for sale. Now, goods available for sale for this period. But for the retail inventory method, we conventional retail inventory method, which is required for this question, right? The lower or average cost will market. This is conventional retail inventory method. We're gonna treat the net markup as part of the goods available for sale. So we have the markup will be treated as markup. We only have retail values, so markup will be treated as a retail value for goods available for sale. So if we add them together, for goods available for sale, we have the total cost and the total retail. So these two numbers are important. It shows relationship for all my goods available for sale between its cost and retail value. Okay, so if we divide the cost by retail, we're gonna get the cost ratio. The cost ratio for all my goods available for sale. It's about 50.5%. This is a cost ratio for all my goods available for sale. Now let's continue with information. We're gonna treat the markdown. Continue with markdown. As a deduction in my retail value, and also inventory loss, another deduction for my retail value, and finally it is my sales. Okay, my sales. Or again, to be more specific, net sales, right? Because we have sales and sales return. Therefore, the net sales will be the difference between these two. Net sales equals what? Net sales is deduction in my retail value. So goods available for sale minus, these are cost information for sales at retail. Goods available for sale minus cost goods sold equals what? Equals any inventory, right? So if we subtract all these three numbers from goods available for sale at retails, we're going to have any inventory information, $125,100. But this is retail. It's not the cost, but we can easily convert the retail to its cost by applying this cost ratio. Right? If we do this, the cost of my inventory under the conventional retail method will be $63,146. All right. So this is for conventional. For other retail method, we're gonna put this markup, okay, and mark down differently. All right. So, all right. this is all we have. If you find any mistakes in these videos, please let me know. Right? Thank you.